What's going on, guys? Happy Friday. Just thought that you guys might want to see this. So it says breaking: Japan stock market crashes negative 2.5% as bond yields hit record territory. Remember the 2.5% drop. You might be like, Ricky, why do I care about that? That's not a very significant drop. That's like if the NASDAQ market or the S&P 500 were to drop 2.5%. Remember, a retracement from previous all-time highs of 20% is considered bear market territory, right? Or I think that would be technically a recession. With that being said, this is the Japanese market. You might be like, well, Ricky, why do I care about the Japanese market? Very true, right? It's completely different than the US market, because if you look at the US market, QQQ is sitting at all-time highs. Both NASDAQ and S&P 500 this week hit new all-time highs. It looks like interest rates are finally beginning to drop. We're at the top of the world, right? Well, it doesn't really feel like that in our economy. The stock market's trading that way, but our economy really doesn't feel that way, right? Well, the reason you might care is because Japan is the biggest holder for US debt. And if for whatever reason they begin to offload the debt that they own on the US, this could put the US in a very tricky situation. Just something to keep in mind. Nothing that you need to panic about. Again, the US market is doing just fine as of right now, for now, right? But this is something that you are going to want to continue to pay close attention to, as again, Japan is the biggest debt holder of US debt. So it says the Nikkei plunged as Japanese government bond yields have surged to levels that have not been seen since the Bank of Japan policy shift, sparking fears of a broader sell-off. So it says Japan's debt to GDP ratio sits at 260%, the highest in the developed world. Rising yields mean higher borrowing costs on the massive debt pile. And I want to remind you, the reason you see such a significant sell-off in their market is because if their yields are rising, then that means that investors are able to earn more interest that's pretty much guaranteed in those markets. So therefore, money pulls out of the stock market and goes into those money markets. So just something to take into consideration. The same thing would happen in the US if, again, our bond yields begin to rocket. It becomes more favorable and viewed as a safer form of investment. Markets are spooked that the BOJ might finally abandon its ultra-loose monetary policy after decades of near zero rates. The warning for America: the U.S. debt has crossed $37 trillion with no signs of slowing. This has been my biggest issue from the very beginning. I've always voiced it. I don't care if you stand on the right, the left, the middle. I don't care what you call yourself. My biggest thing is the mismanagement of our funds and adding to our deficit. Two things that I do not support. I really thought that with this administration, based off of what they campaigned on, that they're really going to change things, that they were not going to add to our deficit, that they were not going to mismanage our funds. And guess what? I mean, with the big, beautiful bill, we're set to add an additional $5 trillion within the next few years. And that's what started the whole debacle between Elon and the Trump administration, is that Elon did not agree with adding more to our deficit. I really think that, again, we're not going to be able to have any other problems if we do not figure out our deficit. That will be the problem that we will not be able to ignore. And again, we're doing this while the market is sitting at all-time highs. Just something that I thought I would share with you guys. Again, not something that I think that you should be very concerned about. Enjoy your weekend. Do whatever it is that you do, obviously. Markets are currently stock market is sitting at all-time highs. But remember, there's a big difference between our economy and the stock market. The stock market is a leading indicator. It represents what investors perceive the markets will do, not what they are actually doing, right? There's a perception there, and they often tend to get ahead of themselves, right? With that being said, one of the trades that I took today was HIMS, and I made $2,500. I closed out my trade fully just so you guys could see it. I also took a little short on SoFi, made $1,200 on that one. But nonetheless, my big focus, kind of the idea that I want to share with you guys, is one thing that I'm considering is HIMS has a common pattern. And again, this is just my trade idea. I like talking to the camera when it comes down to these ideas, just food for thought, right? Not something that I want you to copy. That's not what this video is about. But HIMS tends to have a pretty consistent resistance range, right around $60 to around $67 per share. Really $70, but it's a resistance range around this overbought level. It's beginning to approach it. So it's kind of become more attractive to me to potentially open up a swing trade to short HIMS at these elevated levels. The reason I love this setup is because HIMS is simply a terrible business. It's a business that, again, barely makes any money. Net income is 193 million. Yet again, its P ratio is 67 times its earnings. It has a market cap of, 13 billion and it's lost a strategic partner and is also and was being investigated. That is what led to the substantial drop from $70 per share all the way down to $40 per share. If I'm not mistaken, at that point, ended up losing about 40% of its value. So the reason I wanted to share this with you guys is, again, it's cool to be able to take trades once they actually form, but it's also cool to identify these setups before they actually happen. HIMS does not have to sell off next week, right? It can still continue to uptick, which is why I closed out my short position. But as it becomes more overbought and more elevated based off of previous resistance range, I just wanted you to understand my thought process of, hey, this is normally a level where it tends to get rejected at. So maybe also for those that are considering going long on HIMS, as it's made sense to you, as you know, $40 has been more of a previous support range. It has made sense to go long in that, setup. As we approach these elevated levels, maybe it's something that you choose to also respect, that this is where it tends to get rejected. So hopefully you do your part, either reducing your exposure or taking profits if that's something that meets your criteria, right? So I'm very excited to follow up, just food for thought. There's a lot of stocks right now that are terribly ran fundamentally. They're terrible companies. They lose hundreds of millions of dollars every single year, yet they have 1,000 to 2,000% returns in the past 12 months. Right now, there's such a disconnect between perceived value and actual value. And it's the story of a good story and good price momentum, your company can perform exceptionally well. Markets are supporting these irrational valuations, and we'll see for how much longer. I'm very excited to follow up. I'm going to do my part in doing and keeping you guys up to date. And remember, if you like the way that I dive a little bit deeper into these breakdowns, I'd love to invite you to our live trading session with our LPP team. I trade live with them every single morning, and that's that second link in the description down below. I appreciate your time. Like always, let's make sure that we end the year on a green note. Take care, team.